On set now for a discussion on U.S. corporations, we are joined by Eran Peleg, Chief Investment Officer at Clarity Capital. Thank you very much for joining us today.
Pleasure to be here.
Well, you've recently written about the deteriorating financial profile of U.S. corporations. What prompted that?
So what we've seen in recent years is, we are in a zero interest rate environment. The funding cost for corporations is very, very low, historically low. And we've seen companies take on more and more debt in recent years. We're seeing increased M&A activity, mergers and acquisitions. We're seeing increased share buyback activity. So all of this has led to the increasing in the leverage of the U.S. corporations, which is obviously an increase in the riskiness of those companies.
Well, are these activities necessarily bad?
Excuse me?
These activities?
So it really depends. I mean, look, in itself, M&A activity is a way to invest. It could be good, obviously, especially if you're funding those at a 1% and a 2% interest rate. Then almost any activity is accretive to shareholders. In that sense, it's good. Share buybacks is a legitimate way to return capital to shareholders, like dividends, for example. The issue is that a lot of this has been funded through debt, and that has led to increased leverage. So, for example, for investment-grade, non-financial corporations in the U.S., the net debt to operating income ratio has risen from around 1.2% in recent years to 1.7 times more recently.
Well, is this activity normal for this kind of market cycle that we're currently in?
So it is. Yeah, I mean, typically, this is a cyclical phenomenon. We typically see towards the later stages of a kind of business cycle or an equity cycle that companies start to leverage up. So in that sense, it's not a big surprise.
Well, shouldn't M&A be indicative of a better economy and perhaps stronger companies because they're willing to buy, they're willing to make these investments? So
yes. So again, definitely, there's the positive side of all this. The issue is how is this funded? So, for example, share buybacks. We know that over 400 of the 500 companies in the S&P 500 index conducted share buybacks programs last year. The thing is, normally, this is what you would expect is that capital that's returned to shareholders is kind of the excess cash that the company doesn't need and is returned to shareholders. In this case, though, companies are actually, their share buyback programs are much larger than their cash flows. So in effect, they're raising debt to finance these share buyback programs, and that's what's causing the problem. It's not an imminent problem tomorrow morning necessarily for shareholders, but it is a trend to watch and could be of a greater concern later on.
All right, so this could be a bad sign here. But what about Israel? We're seeing a lot of M&A activity. Do you have the same concerns?
Israel, we are seeing, again, similar phenomenon, I think, in Israel. The numbers are obviously much larger in the U.S. Europe, Japan, each region has is a completely different situation. The U.S. at the moment is most advanced in this process, and that's where the major concern lies in this respect.
And in terms of Israel, what are you noting at the moment about the health of the corporations here?
So there's, the corporations to start with here are much smaller, and they're much more vulnerable to start with. The economy has been generally relatively stable over time, but we're still seeing, and there's been a big wave of defaults after the 2008 crisis. We're still seeing some of that more recently as well. We just had in the food retail sector, Mega, which has been under major distress. The thing about Israel is not that much the cyclical thing, but more we're going through many structural changes here. Some of them led by regulators, and this is causing disruption in markets, like in food retailing, for example, which is then putting some companies into a distressed or problematic situation.
Well, thank you very much for providing this insight to our viewers. Eran Peleg, very much appreciated. Clarity Capital.